Good morning, everybody. We'll be starting at 9 o'clock. We're just quickly running a bit of a sound test. Good morning. Just testing the sound again.
Can hear you on both sides.
Thank you.
Malaga, can you maybe just confirm that you can also hear me when I'm presenting?
Can hear you too, Ninka. Just a bit delayed on the delegate side, but I can hear you.
And you can all hear me.
Yes.
That's correct.
Thank you.
All right, good. Then I will see you in 5 minutes. Right, good morning everybody and welcome to our Caseware financial statement sessions of our Get Ahead series. My name is Angela Fantonda. We met briefly during the cash flow worksheet session in the last set of workshops, and I trust that you were very excited about cash flow and that your Friday night braais entailed a lot of conversations about Caseware's cash flow worksheet. Right, I'm going to switch off my camera now and go ahead with the presentation in audio. As always, your microphones are muted and cameras turned off. So sorry guys, it's not an opportunity for a showcase today, maybe on another event. And you will be eligible for 2 hours of CPD on this webinar, but you do have to stay for the full duration. If you do lose your signal, please exit and enter again, and then use the app rather than the browser. But a recording will be made available, so don't panic on that. There is a panel for questions, so please use this to ask us your easy questions. I'm just kidding. You're welcome to direct difficult questions to us as well, and we will do our best to answer them. Please do participate. Ninka will be standing by to answer the questions that arise. We will take slots at the end of the session and right at the end of the session to take a look through your questions. All right, so without any further ado, let's take a look at the agenda today. We are going to be covering IFRS accounting standards versus the IFRS for SME standards. We're going to take a look at retained income and rounding, other comprehensive income, and then we're going to take whatever questions have not yet been answered. Right. So with regards to the IFRS accounting standards and IFRS for SME accounting standards, the first thing I want to point out here before I actually really get started is this is not specifically a technical accounting lesson. The objective here is really to showcase the differences between IFRS accounting and IFRS for SME accounting on the Caseware templates. Obviously, we can't completely divorce the two because we do need to look at the actual accounting, but it's not a full-scale accounting lesson. Sorry, guys, I know you were hoping for one. Also, because there's so much jumping around required to be able to showcase the differences, we have set this up differently than the previous. So there isn't a case study for you to go through with us on your side, but just follow the slides and follow the explanation. And then afterwards, this evening, when you've got nothing to do, you can perhaps run through the two templates side by side for entertainment, as I'm sure all of you love to do. Right, so first of all, do you notice the long-winded explanation here? IFRS accounting standards versus IFRS for SME accounting standards. Now, the reason that I've done this is because the IASB have actually amended their terminology. They have added a suite of standards for sustainability together with the accounting standards. So IFRS is no longer just the accounting standards. So there's IFRS accounting standards and IFRS sustainability standards. So we actually have to identify what we are referring to. So this is the reason why we have added the accounting standards. Throughout the presentation, I have sometimes added it, sometimes not. I'm always talking to accounting standards. Okay, let's move on. So just as a bit of a highlight, just to remind us, what is IFRS for accounting standards, SME for accounting standards, where does it come from? Well, as we all know, full IFRS is quite a wad of requirements, accounting requirements and disclosure requirements. And a lot of it could be unnecessary to certain users of financial statements. So the standard setters then came up with the SME accounting standards. It's a single standard with various sections, which can be used by qualifying entities. It basically started with IFRS and the objective was to modify it and simplify it for the users of typical SME type financial statements, also taking cost benefit considerations into account. So the SME was a much simplified, some of you might argue not necessarily the case, but the intention is for SME to be a simplified version of IFRS. So it was applicable, or it is applicable only to entities who have got no public accountability and who publish general purpose financial statements for external users. So you will or won't recall that public accountability means that an entity who has got debt or equity instruments traded in a public market, that they would not be allowed to use the IFRS for SME. So be careful there, it's not only equity instruments traded in a public market, it's also debt instruments. Also, if they hold assets in a fiduciary capacity for a broad range of, or broad group of outsiders, this could be banks and insurance companies, for example. These type of entities have public accountability and may not apply IFRS for SME accounting standards. Everybody else can, provided their regulators allow them to use IFRS for SME. And so it actually has nothing to do really with the size of the entity. So just what I want to point out here, IFRS versus IFRS for SME accounting standards. There are quite a lot of significant differences between the two, if you take a look at the standards side by side. However, recently, if you've been following the news, the IFRS for SME accounting standard has been reviewed, and we're expecting that it will be shortly. Now, within that standard, it says that the effective date could be a year from issue date. So let's assume it's issued very soon, it could be within a year and a half to 2 years that the changes will be effective. However, we need to see what the transition will be on that when it's issued. The areas where we expect the gap to reduce. So you will know that in the last several years, a lot of IFRS standards have been issued, and it has taken IFRS quite a bit away from the IFRS for SME. So that's what I'm referring to when I say the gap is expected to close. So some of the areas where I expect that closure will take place, or reduction at least, is with regards, first of all, to material accounting policies. So you should be aware that the IAS 1 was amended to require for IFRS that entities present material accounting policies rather than significant accounting policies. It's more than just changing the word in the sentence to read, these are the material accounting policies, as opposed to the significant accounting policies. You're actually required to consider what are the accounting policies that are material to the entity, make them specific to the entity, and disclose those. Now, the specific to entity is not the change, that's always been a requirement, but the IASB and IRBA and SARCA have been very closely monitoring what is presented in accounting policies. So they will be watching the IFRS accounting policies, and very soon also then watching the SME accounting policies, because the same kind of changes worked through the template, that the accounting policies have been set up in such a way that you really have to think clearly to make your accounting policy specific to the entity and not just make a copy and paste from the standard. So you're going to see a lot more of this coming through in the SME templates in the future, as well as the new standard comes into play. We're also expecting the gap to close on reconciliation of liabilities. What I mean here is that in IFRS, IAS 7, the cash flow standard, requires entities to present a reconciliation of their financial liabilities showing non-cash movements and cash movements. This is not required in SME at this point. We expect it to be included. Then the expected credit loss model in your financial instruments. This is quite a tedious, a lot of disclosure in IFRS. This is not yet required in SME, but the expectation is that expected credit losses will come into the SME standard as well, although I expect not on trade receivables and contract assets, but we will see when the final standard is issued. Then they're bringing in the acquisition method for business combinations as opposed to the purchase method, which is still currently applied by the SME standard, so that gap will close. And then, of course, revenue from contracts with customers. Now, I don't know how many of you have ran out the room when I mentioned that. So yes, the revenue from contracts with customers is also going to change from an SME perspective, because currently it just works on the transfer and of risks and rewards model. All right, so that was just a brief overview. So like I've said, so there currently are a lot of differences between IFRS and IFRS for SME, mainly with regards to disclosures. Even when the gaps are closed, there are still going to be differences. So the reason I'm trying to emphasize that there is a difference, there are differences, is because I want you to understand that the Caseware templates are not interchangeable. So please don't try and apply the IFRS template to an SME client and vice versa. You are very likely going to land up with non-compliance issues. So the purpose of this session is to take you through some of the differences in the standards, but my main aim is to show you how they are presented differently in the two templates at this point in time. So first of all, our investment property and biological assets. In the IFRS for SME, you are actually required to show a separate line item for investment property or biological assets at fair value and those on the cost model. This is not a requirement for IFRS. So in IFRS, investment property is a line item and biological assets is a line item. So what we have done in the template for SME is that because it's separate line items on the face, and because the disclosures for fair value model or for cost model are different, they're not necessarily very different, but the disclosures are different, we've actually created a separate note in the SME template for each category of investment property and biological assets. So that is one of the main differences in the templates. Here, I'm just going to show you what it looks like. I've extracted a piece. So in the SME, on the statement of financial position, you will notice the various different line items. And like I said, they link to their respective notes. But if you look at IFRS, it's only investment property or biological assets. Okay, irrespective of whether there might be one property which couldn't be fair valued, for example, and had to be recognized at cost. But of course, you know that your accounting policy should be either cost or fair value where you're looking at IFRS. Then we have this beautiful concept of the statement of income and retained earnings. This statement only exists in the IFRS for SME. So what it means is if you've got a company and the only movement in equity during that period was profit or loss, or dividends, or any corrections of prior year errors, or any changes in accounting policies. So basically, if the movement only was to retained income, but not other movements to retained income like transfers, this must have been the only movement. Then they say you can actually drop the statement of comprehensive income and the statement of changes in equity if you wish, and just present a statement of income and retained earnings. So this you will only find in the SME template. So let's take a look. So if you are in your SME template and you go to your statement of comprehensive income and you stand on the settings icon, you will then find an option to present the statement of income and retained earnings. So you'll select that, and what you would notice is your statement of changes in equity and statement of comprehensive income is then replaced with this, a statement of income and retained earnings. And you would see it looks very much like your normal profit or loss, ending with the loss for the year. And then we have got any prior year errors or changes in accounting policy or prior year adjustments against retained income to give us a restated opening balance, and then our ordinary dividends presented on the face to give us our accumulated profit or loss at the end of the year. Now, I don't want to give away my age, but back when I was in school, this is very close to what the income statement looked like. Now, I don't know if anyone is laughing with me in memory of this, but those were the days. All right, so this is your statement of income and retained earnings. I just want to point out quickly for you, you will notice in my screenshot here that these items that I'm highlighting are in blue. So all that you would see if there were no other prior year errors or changes in policies, you would literally have your loss for the year and then jumping straight to your opening balance, showing then your opening balance. Your dividends would come off and then your closing balance. So this section will only turn blank if there are actually prior year adjustments. Okay, happy. Next component I'd like to look at, just in terms of how it differs between the two templates, is other comprehensive income. Later in the session, I'm going to talk about the mechanism of other comprehensive income, but for now I want to show you how the two differ in the templates. So on the face of it, it looks quite the same, doesn't it? We've got other comprehensive income in our SME, other comprehensive income in our IFRS. We've got items that will not be reclassified to profit or loss. We've got items that will not be reclassified. So it looks the same. But when you start to look through the actual components, you will notice that they are not in agreement. Because the different standards, IFRS and IFRS for SME, specify what qualifies as items of other comprehensive income, and also whether or not they will reclassify to profit or loss. So look at this interesting one. Do you see in SME, exchange gains on translating foreign operations is sitting here in the items that will not be reclassified to profit or loss. But in the IFRS, they are sitting in items which may be reclassified to profit or loss. So if you try to use the one template for the other purpose, if you try to use an IFRS template for an SME client and you've got exchange differences on translating foreign operations, you're going to have non-compliance because it's going to be presented in the wrong part of the statement of comprehensive income. Fine, isn't it? All right, looking then at new standards and interpretations. This, I think, is one of everybody's favorite presentations. The new standards and interpretations note requirement is only required by IFRS. It's set out in IAS 8. It's whenever there is a new standard or interpretation which has been issued, but is not yet effective, the entity needs to disclose the fact that they've not applied the standard and what their expected or possible impact is going to be on the financial statements. IFRS for SME doesn't have such a requirement. Although it's a single standard with various sections, even though the sections may change from time to time, you are not required to present the impact of changes which are not yet effective. Okay. So if you look in your IFRS template, just after the changes in accounting policy, you will see this note, new standards and interpretations. If you open that, this table is updated regularly. So with each release, the table is updated with whichever new standards have been issued till that point in time. So if a standard is released and it's before the release, you have got the ability to actually just insert it yourself. Sorry, this is just a screenshot, but at the bottom of the table, you can add extra and then you can just add the one or two that were released in the meantime. But this is updated, like I said, with every release. How the table works is it presents to you all of the changes and the issue date and the effective date. And then the template works out based on the date of your financial statements, whether these effective date is previously in the current period or in the future period. You can override this. So if you decide, for example, no, supplier finance arrangements we are actually going to adopt now, then you will click in this box And when you press apply, it will rearrange these standards to put them into the appropriate category, because what we want to present is everything that's ticked in the future, right? What does that mean? We want to present all of these standards which are not yet adopted, but they have been released. So this is just our control table. This does not print. This is just for the software to work out what should be printing or presented. So if I move to my next slide, this is what you would see. So at the bottom of the table that I just showed you now is then the actual note starts. Standards and interpretations not yet effective. So this is what it does. Into this category, it goes and it filters all the items which were ticked as will be adopted in the future. So you can select whether you want the detailed note or the shortened note. The detailed note is our recommendation, and it's what I've just presented to you. What happens is it takes the name of the standard, explains the change, gives the effective date, and then you have to select what the impact is expected to be. Okay, so this detail is not found in SME. Any excited cheers there? I wish I could hear the applaud. Right, moving on to intangible assets. IFRS allows the recognition of internally generated intangible assets if certain conditions are met. You know those 6 criteria for capitalizing development costs. IFRS for SME does not allow it. It's straightforward. Research and development is expensed. So that again is a significant difference between the standards. So I would show you where you would mostly see it in the accounting policy. If you go to IFRS, you will see under intangible assets that we've got a section where development costs on, and then you would have to make it specific. What are the development costs which are assessed by management as meeting the criteria to be capitalized are included in intangible assets. So basically, this accounting policy allows for capitalization of internally generated intangibles. Go to the SME template, straight up, research and development costs are recognized as an expense in the period incurred. So again, if you're on the wrong template, you're going to get potential non-compliance. Borrowing costs, very much similar. In IFRS for SME, borrowing costs can only be expensed. Another round of applause and great cheering, please. But for IFRS, you would capitalize them if it's on a qualifying asset. And this isn't a choice, this has to be done. So again, in the accounting policies, SME, you will see borrowing costs are recognized as an expense in the period in which they are incurred. However, for full IFRS, you would see there's a whole, or actually we've got these radio buttons if you have not yet familiarized yourself with them. Whichever one you select will bring up text related to the choice. So if there were no capitalized borrowing costs for the IFRS, you would select the first choice. But I'm showing you when they do have borrowing costs capitalized, and then there's a whole section about how and when borrowing costs are capitalized. Then goodwill. IFRS for SME, we have a requirement to amortize goodwill and test it for impairment, and it would be over its useful life or a period of 10 years if it cannot be determined. Again, you would make it specific to the entity, so you would select the basis of amortization and insert the number of years. If you look, I'm only an SME on this slide. If you look at the note, you notice on the reconciliation of goodwill, there's a column for amortization of goodwill, which is obviously then your depreciation of goodwill. Moving to the IFRS standard or the IFRS template, there is no depreciation or amortization of goodwill, only an impairment test. So our accounting policy, I just go to the part, it says goodwill is not amortized, but is tested on an annual basis for impairment. And so it goes on. If you look at the note, our reconciliation of goodwill, you will see that there is no column for amortization. So please don't phone the call center and complain to them, because where is the amortization of goodwill on this table? That is the reason why. Financial instruments, please don't run away. It's not going to be that bad. It's not a financial instruments lecture, just a few pointers. So, as you know, I hope you know, IFRS requires a lot of disclosures for expected credit losses. This is not yet required in the IFRS for SME, but I did mention that this is expected to change. So you can rejoice, but keep your rejoicing down. Although it's unlikely that the disclosures will be of the same magnitude as that in full IFRS. IFRS has got a lot of disclosures about risk management and financial instruments, much more intensive at this point than the IFRS for SME. You can go and take a look in your IFRS template. There's quite a large note on financial instruments and risk management. Like I've said, the gap is expected to get smaller with the new IFRS for SME. That gap won't be closed altogether. So if we just take a look, I want to show you what I'm talking about. What do the disclosures for ECL look like? I've taken loans to shareholders as an example, and this is out of the IFRS template only. So it will be on loans receivable. We list our shareholder loan. We will split between current and non-current assets. And this is very close to your current SME disclosure. And you would also just show what any write-offs are or impairment is for shareholders' loans in the SME standard. But in the IFRS standard, we've got this whole section on exposure to credit risk. So we talk about the exposure, then you need to talk about the credit rating framework. So this basically tells us what is the risk profile of the various debt instruments. And in my example, I'm saying that we've not used external rating agencies. We have had to do our own internal rating. So when that is the case, and you would see this table in Caseware, this is what its purpose is to list what your internal credit grade is. You don't have to use performing, doubtful, in default. This is the example. Then you would describe, okay, well, if we say that an instrument is performing, our definition is that there's a low risk of default, no amounts past due. And then we say, if that's the case, we recognize a 12-month expected credit loss. Then we might say if it's doubtful, it means 30 days past due, or there's a significant increased credit risk. And then we say for those, we use a lifetime expected credit loss model, but not credit impaired. So you understand, so you would go through describing the credit rating. Then the next step, still in the same note, is to now actually set out your gross carrying amount, your loss allowance, and your amortized cost of your instruments based on their credit rating grade. So if shareholder 3 was actually a portfolio of loans, and they were some performing, some in default, some doubtful, I would actually have to split that up to show them and their different basis of loss allowance, some 12-month ECL, some lifetime, and so on. And then I would show what their gross carrying amount and loss allowance is, the current and the prior year. Then the next step is to go and explain the movement in that loss allowance, also by the risk category. So it would be, for example, I'm dealing with shareholders, which type of shareholders? So in this case, I'm dealing with my local shareholders, let's say, and for the loss allowance measured at 12-month ECL. I could also, in addition, have local shareholders measured at lifetime ECL. And then I would have a second table. So if you look through the template, you'll see there's something like 5 tables there. It's so that you can split it out based on their risk categories. So then you would take your expected credit loss for this class of shareholders, and you would show the movement to get your closing balance of expected credit loss. You would also have your movement in gross carrying amount on which this is based, because it helps to explain the movement in your expected credit loss. So I wasn't trying to explain how ECL disclosure works or what the requirements are, but just to show you what is in the IFRS template for expected credit losses that is not in the SME template. Okay, the next one that's a whole lot of fun is your revenue from contracts with customers. IFRS has got the 5-step approach, you know, where you identify the performance obligations, you determine your transaction price, you allocate the transaction price, and you decide is it going to be recognized over time or at a point in time. Now, IFRS for SME is currently quite straightforward. straightforward. You're basically still looking at the transfers of risks and rewards of ownership. This gap is also expected to get smaller with the new IFRS for SME. Currently, it's still on the transfer of risk reward model. So if we take a look at the template again, what does the presentation look like? Our top extract, sorry, I've cut off the template, but my top extract is my SME revenue note, and the bottom one is my IFRS note. So SME is quite straightforward in my example. I'm just showing my revenue by class. I've got sale of goods and rendering of services, and life is good. And then of course I've got my accounting policy. For IFRS, I've got my revenue from contracts with customers, and I've broken it down into sale of goods and rendering of services. Please don't try to reconcile my amounts. It's two totally separate files. There's no congruity between these trial balances at all, okay? Right, so I've got my sale of goods, rendering of services, and this is my revenue from contracts with customers. Then I show what other revenue I have that is not from contracts with customers. So in this case, I had some rental income, and that will be my total revenue. Now I must take my revenue from contracts with customers and disaggregate it further. And then, for example, I've taken my sale of goods and I've said, okay, well, this was sale of machinery and sale of parts, and whatever disaggregation basis you have adopted. Rendering of services, I've said what the rendering of services were. It was maintenance of machinery, let's say. So we've disaggregated the revenue into its more detailed components. And then we've also said, well, how much of it was recognized at a point in time and how much over time to give us our total revenue from customers. So again, if you were to use the SME template and try and apply it to an IFRS entity, you are going to land up very short on disclosures. And if you try to use the IFRS standard for SME, at this point, you're going to over disclose. Okay, is everybody doing fine? I assume so. Non-current assets held for sale. This is something which you would only find in IFRS. If you think it's IFRS 5, so if you've got non-current assets held for sale, you actually have to reclassify them to current assets. So if we look at the IFRS template to the far right-hand side, I've got an extract of our statement of financial position. We've got non-current assets, current assets, and then our non-current assets held for sale and assets of disposal groups. So we've taken whatever assets were classified as non-current held for sale, we've taken them out of these various categories and we put them into this line. Then we have a note talking about the transaction and listing the various assets, liabilities of the disposal groups that were transferred to non-current assets held for sale. In this case, it was just a one-line item. What have we got in the IFRS for SME? So in the SME, there is a concept for major assets and liabilities subject to a binding sale agreement. So these assets, quite similar, but these are only disclosed, not reclassified. So obviously your measurement is different as well, because remember for full IFRS, you would actually stop depreciating or stop amortizing the assets once they are classified as non-current assets held for sale. But under the SME, let's say it was a PPE item that's subject to major or to a binding sale agreement, you would continue to depreciate that until the sale. However, there is a note in the template where you would present the various assets which are subject to this binding sale agreement. Then lease accounting. Under full IFRS, and this question came in recently, in full IFRS, you know that we've got IFRS 16, which depending on where you are in your education or your journey, you may or may not have known about the finance lease and operating lease in full IFRS, but I think that we are still there where we're all familiar with that concept. But under IFRS, you used to be able, or you used to have to recognize a finance lease if it met the certain finance lease criteria, and everything else was recognized as an operating lease and basically presented on a straight line basis. But IFRS 16 requires all leases now to actually recognize a right of use asset and a lease liability, which is very much conceptually, if you will, aligned to the way that we were used to doing finance lease accounting. It excludes your short-term leases and your low-value leases, which would still just be expensed, for example, on a straight-line basis. However, IFRS for SME still retains the finance lease and operating lease concept for lessee accounting. Okay, I emphasize this because IFRS also retains the concept for lessor accounting, but the lessee, the one who is using the asset, has to capitalize the asset for IFRS. But if it doesn't meet the criteria to be classified as a finance lease for SME, that same lease could still be recognized as an operating lease in SME. So we were asked the other day, where is right of use assets in IFRS for SME? It's not there because SME does not have the concept of right of use assets. And I speak under correction, but I've not seen this expected to change in the new standard. Like I say, I speak under correction. It could be coming through as a change as well, but I'm not expecting it. So I just want to show you what you can expect to see on the face. That's a difference. So on my left, right of use assets, IFRS balance sheet or statement of financial position, there's your right of use assets. So your lease assets will be recognized in this line, or you could still recognize them as part of property, plant and equipment if you desire. You would notice in the liabilities, it's lease liabilities and not finance lease liabilities. On the SME standard template, no right of use assets. Like I said, there's no such concept. If there is a finance lease, the asset will be included in the related asset. It doesn't have to be property, plant and equipment. I'm just using that as the example. And then of course, SME still has finance lease liabilities. Okay, we're almost at the end of this section. I want to talk about the second comparative for restatements. So IFRS requires that if you have a retrospective restatement, that you should, for example, change an accounting policy or a prior error, that you should show a second comparative balance sheet. So this is only in IFRS. So if you are in your template for IFRS and you go to options and then you select column setup, here you will select the next comparative. In this case, it was 2021. You're only required to show balance sheet and related notes with the third or the extra comparative, but you can choose all notes and all statements if you wish. And then this would present, sorry, on the top here, you would see what changes is that you land up with 3 periods in your financial statements. This is not provided for in SME. All right, that basically finishes my session. In a moment, I'm going to just let Ninka let us know if there are any easy questions which I need to answer. But after that, we will have a short break and then Ninka will take retained income and rounding. Ninka, is there anything you want to add?
Hi, Ange. Yes, there is one question that user is just asking if you can please recap the revenue presentation. He missed that a bit. So if you can maybe just recap the revenue presentation of SME and the difference between that and IFRS.
Okay, I'll go back to that slide. So yes, so for SME, at this point in time, it's just based on your, you would recognize your revenue based on the transfer of risks and rewards of ownership. I haven't put here the accounting policy. You can just look in the template in your on your software, but it's basically saying as much. So the disclosure is as limited as this for SME, and then you would say what the basis is for how would you recognize when the risks and rewards of ownership have transferred. But I'm going to just recap the full IFRS as well. In IFRS, there's a lot of disclosure requirements, including breaking down what your revenue from customers comes from. So my example said sale of goods, rendering of services. And then you could have revenue that's not from contracts with customers. These will be presented separately. In this example, it was rental income. This is if your rental income isn't, it's more incidental and not actually from a contract with a customer, in which case it would be part of this. And then you have to disaggregate it into almost to look at, I don't want to say risk profiles of your revenue, but break it down so that your user can see what exactly is it that you are deriving revenue from. So yes, you're selling goods. What are you selling? So I've just said I'm selling machinery and I'm selling parts. I could have also said I'm selling machinery into the export market or into the local market. So it depends on the nature of your business and what your really want to try and risk is the wrong word, but it's the word that is coming to me. I don't know if that makes it clearer. You want to explain to your users where the sales are coming from and what they are on. So your disaggregation might be by geography, or it might be by type of product, for example, or it could be a combination. And then you would say, was it a point in time or was it over time, which is generally your rendering of services. This also has to do with at what point in time the risks and rewards of ownership transfer. In addition to this, your accounting policy for revenue from contracts with customers, very, very specific, because you're going to have to explain exactly the nature of the different types of revenue items, how you've determined the performance obligations, how you've calculated transaction price. Is it recognized at a point in time or over time? And you'll do this per type of revenue item. So your accounting policy in IFRS, very much more complicated than SME, where you could almost get away with our revenue is recognized when the transfer of risks and rewards of ownership has passed. Okay, Ninka, I don't know if that covers that or if there's any other questions.
Thanks, Ange. I do think it covers it. There's one more question here that I'll maybe just take, what they ask about the decision-making process, whether to use IFRS or IFRS for SME. So how you can go to the Companies Act and you can just have a look there on what the requirements are, but it's normally your public accountability or your listed companies that must use IFRS. There's requirements there that splits it out. I think you had a slide on it, Ange. But it really is your larger entities. But there's no, everybody else can use SME. So I would suggest that you go and have a look at what those requirements are. I think it's 5 types of entities. State-owned entities is also one that must use IFRS. But have a look at that requirements for your specific entity. And then I just one more question, that this might be a bit technical because we're not really that familiar with the ECL calculation. So Shelter, what we'll do is we'll reach out to you just to understand your question a bit better and see if we can assist you in that.
Okay. All right, thank you, Ninka. Is that all on those?
Yes, that's it. Thank you.
All right, so let's take, it's now just before 9:45. I think if we take a short comfort break until 5 to 10, and then Ninka will go on with retained income and rounding. So at 5 minutes to 10, we will carry on. Thank you very much.
Hi everybody, and we're going to continue with retained income and the rounding. For those of you that don't know me, my name is Ninka and I'm the product manager for the financial statements. I do want to apologize if I'm going to mute myself in between the sessions. I'm still recovering from a bit of a cold, so I have some coughing sessions in between. So if you do lose sound for a bit, just give it a second. I will be continuing very shortly. Right, so with retained income and rounding, the two are quite go quite together. It's very hard to decouple the two. So I'm going to refer to both of them, and I hope at the end of the session, both of these topics would make sense to you. So firstly, if we look at retained income, what is retained income? So retained income is a sum of an entity's earnings from a prior period after deducting the dividends paid to the company shareholders. So if you think about it, it's an accumulation of that company's profit and loss throughout its entire life. Then deducting obviously the dividends that gets paid out to the shareholders, and the net balance of that is retained earnings. So it really is a summary of your income statement from inception date. So if we look at a small example here, you normally have your opening balance. So if you think about the 135,000, that is actually your accumulation of your profit of all the previous years. Then you have your income and profit for the your income or loss for the current year that gets added or deducted. Then you get your dividends, and then you have your closing balance. And so it continues year on year. So keep that in mind as we go along. I'm sure you're all very familiar with what retained income is, as we go through the different scenarios and the different journals and the differences that it sometimes can cause in your financials. I'm going to switch off my camera just for bandwidth, if there's anybody struggling, and that we can go through the different options. Right. So in Caseware, if we talk in general, you can have multiple accounts that are mapped together to one option. And I'm going to jump a lot between the slides and the and the Caseware file because I really want to show you the examples. So for example, you can have revenue that can be one account, made up of one account, or that is made up of 10 accounts. And depending on how many accounts there are, the rounding works a certain way. So if you have one account mapped to revenue, it will obviously just round that one account. But if you have like 10 accounts, what it does, it takes the total of all those accounts together, and then it rounds it to that line item. So for example, I'm going to show you now, I've got a very small TB. Let me jump to that quickly. It seems that I've lost my TB. There it is. So what my TB does is, you'll see here, I've got, like I said, very small TB. It's got revenue, it's got some expenses, it's got some finance cost, and then I've got some balance sheet items. So really a very, very small TB to illustrate this. And this is my current year balances, and this is my prior year balances. And you'll see throughout the session, I'm going to refer to the prior and the current year. Understand that in your practice, you normally will do the prior year as the current year, roll forward the file, and then that will be your comparatives. But for this rounding exercise and retained income, it's quite nice to show it in the prior year and then the effect on the current year, even if you're in the same file. So if I now look at revenue, for example, sorry, you'll notice here that I have all these accounts mapped together, right? And then that comes to this figure that I've got here. So just bear with me if I go through this, you don't have to understand the whole TB. The same with the operating expenses, I've got all those, it comes to the 644, and the same with the finance cost that comes to that. If we then jump into the financials, let's just focus on the revenue line and the operating expenses lines. Right, so if you look at there, you've got 983,963. And then you have, and your operating expenses, the 644,761. And as finance cost, you have the 4. So if you think, keep those 3 numbers in mind. If I jump to the notes, for example, you'll see here, revenue is just, it's a one line item. There's not multiple ones. And the same with the finance cost, it is made up of that one line item. So if I now go to my mapping, and just to illustrate the different processes, I'm going to map those different accounts to different line items so that you could see how that would then work differently. So if I go to my income statement here, you'll see there is my revenue figure. And if you remember, that's the exact figure that was in my Excel file as well, because it all gets added together. But let me unmap these for revenue quickly. And I'm going to put under revenue service, one under construction contract, royalty, and rental. Let's do the same with the OPEX. So I think put them all just under other here. Again, just unmap those, and we map those to different line items. And the same with the finance cost. So like I say, if you map everything together, it rounds on this level. But if I map everything separately, then it maps per each mapping level. Right, and let's apply that. If I now go back to my financials, you'll see, if you now look at my finance cost, that note has changed completely, right? Because now I have here my 11111s, and here I have my 2. If I go quickly jump to my Excel, so that's those figures there. So that one is rounded up to be a 2. That one is 1, 1, 1, 1. What happened in the prior year is you'll see that all these are less than 0.5. So they actually show as nil here because they're rounding each line separately and they're rounding mathematically down to the previous number. When they were all together, all of these mapped together, then it would sum it first. So that would be, the sum would be 2.45, and then they'd round. And that is why you then would have a result of 2 and not of 0, 0, 0, 0. So if you now think about it, if that's now our finance cost, the same with our revenue. Before, this was 983,963, and now it was 962. So it really just depends on what your decimals are to what it round to, and also then how it is mapped, if it is mapped together or mapped differently. But if you think about it, that is why you most likely always will have a 1 or a 2 year that's out of balance, because you have this that happens. You also have this thing accumulating over the years. So what really should happen is the 1 year you might be a 1 rand up and the next year it will be a 1 rand down. So it might not even be the same adjustment that you have to process each year. But you definitely will have to consider what you need to do to correct this. So if I jump back into my slides, so what then happens if you now pull this through to your retained income difference? If it is mapped together, my profit would be the 339,198. Mapped together meaning all the revenue together, all the OPEX together, all the finance costs together. If I, however, map them separate like I have now, then my profit changed to 339,196. So there's a 2 rand difference because of the rounding and how it is mapped. We get a lot of support calls on this. I've got this 2 rand difference, where does it come from? My TB is balancing, how come my financials not balanced? And this is where it comes from. So it's not something that the software is doing wrong. It is purely how it works because of rounding and decimals. So what can you do about it? So there's 4 options, and I'm quickly going to let them come in. I'm going to talk about them and then I'm going to show them to you. So the first thing is, what you can do is you can go in your financials and you can set that rounding. I'm going to show you to do that, the automatic rounding. So what that does is it plugs that difference into a certain line item on your financials. We have all the trade payable and trade receivable as options there. Secondly, you can pass a journal, and I'm going to show you that one as well. While you import the trial balance, you can round your TB, and then you can also round your TB balance in Excel before import. So let's maybe quickly first look at the Excel ones, and let me just explain what I mean there. Is if I now look at my current year figures here, what I can do is I can then round it here. So I see here I've got a difference because I didn't put that 780 in there. The accountant and me will not sleep if we don't fix that, right? So you can see here that I've rounded. I've just put in a formula here to round it to 0. And what it will then do is your TB will automatically be rounded when you import it. So very manual process, but possible to do. What you'll see here is this R2 difference at the bottom, which if you remember is the same difference that we have in our financials. So what you'll have to do before you import this TB is you will have to go and decide where you're going to put this R2 difference in. Are you going to put it to revenue, expenses, or trade payables? What do you want to do with it? So this illustrates to you what you manually do. But if you just import your TB, which is in column D, that comes from your accounting system, it is the same principle. You have to decide where that R2 goes to because of rounding. So like I say, there is 4 options to do. This is the one that you, before you import the TB, you can basically round it. The other one, if we quickly look at the other TB option, is if you import if you import it as an Excel file, you do also have an option for it to round automatically, and the system rounds it for you. You can choose a balance sheet account and an income statement when you do this. So it does work better if you have already mapped your TB, if it's a recurring file, a roll forward file. But you can also do it without it. So what you have, if you come to this screen, you have this round balance option here. If you click on that, you have the settings here on the side. If you select that, then you can see here rounding differences. And you can actually round your balance sheet to a specific account and your income statement to a different account. So why this works better if it's mapped? Obviously because then it knows which account is balance sheet and which accounts are income statement. So it does work more accurately if you have a mapped TB already from the previous year, even if it's not all the accounts or the majority of the accounts are mapped. So this is a way that you can basically do exactly what I've shown you in Excel, that you can do just in the software itself. The other options that we normally use is a journal. So this is a journal that I've written, and what I'm going to do, let me just quickly jump here. You'll see there I have the R2 out, and let me jump to trade payables just to show you that one. So what you can do is you can pass a journal to this. Now, a lot of people ask me on this specifically, they can just pass the one-legged journal and that's okay, and the system doesn't work because it's a one-legged journal. It's not a one-legged journal. Your retained income works a little bit different than the rest of your financials. Because what your retained income does is when you open your statement of equity, you will compare this figure here with what is in your signed financials. And if there is, because of rounding in the previous year difference, you'll come here and change it. So if I go here, you'll see I've overridden this. It was 000. But my signed financials set a 2. Because I processed a journal here, this figure won't, or because it's overridden, this figure won't change when I post a journal against retained income. And that is why we have this balance check at the top to tell you there's a difference between your trial balance, if this is this line here, your trial balance and what is in your financials. So this journal, you might pass as a one-legged journal, but it is not. You actually are passing it against retained income. So I'm going to process that journal, and then you'll see what happens. It goes, my financial statement balances now, but it tells me my retained income doesn't match the previous year because in the previous year I had that R2 difference. The other option, which most of us use, is, let me just go and switch off that journal again to show it to you, is then you'll see we'll out with the 2 again. So if you look at this number, you have the rounding option here, and it's available in both document configuration rounding. And if you click on that, you get this box here. And what you can do is you can say automatically round. And then you can select, does it go to trade payables or trade receivables? I'm going to move this a bit here. So all of these processes is the same. It's you have to decide where you're going to put this R2 rounding in. And like I say, you might have in the previous year, you've got a R2 journal that you process every year. Now suddenly this year it's R3 and now I don't know why it's more. It's because this year your rounding for this current profit has worked out a little bit different. So normally goes up and down. It won't stay exactly the same each year because of that. So what happens here is it basically changes that whatever difference is here goes to this line. So if I select trade payables, this is 8908 at the end, and I click on OK. Then you'll see it will change to, just give it a second. You'll see there it'll change to the 19. And then it also gives you this P3, P4 in the stance to tell you that is the plug-in cell where the difference is being allocated to. And you'll see here that you are balancing them. So this is an option that you use mostly because it is the easiest to do. The only time that a BC client is not really using this option is when they don't have trade payables and trade receivables. We believe it's the most commonly used, but there might be like you do a small dormant set and then you would use one of the other options. You would pass a journal or you would round your TB before you import it, and then you'll get the same result. Right, so that was rounding in very basic form. I'm going to take it a step further and let's talk about retained income. So like I said, retained income is the accumulation of your profit or loss for all the previous years. So what happens is if you process journals in your trial balance for us purposes, then there's different actions that needs to be taken for the next year. And the reason why, like I explained to you, this balance check at the top, what it does to tell you what is the difference between your statement of equity balance and what is in your trial balance. So it is a warning and there should not be a difference here. The only time that it is okay that there's a difference here is if you have on your statement of equity a retained income movement other than profit or dividends. So if you have sometimes a transfer between reserves and retained income, then it will show up there. But that figure should only be your figure of statement of equity. Any other figure, there's something wrong. And normally when there's something wrong, it's because of a journal. And normally if it's because of a journal, the other side of the entry is the part that you are missing. So let's look at an example of how this will happen in practice. So let me just see if I go to my journals. Okay. So what happened is now I got my TB from my accounting system, and let's pretend in this scenario that you are actually there's different scenarios of you can prepare the financials and do the accounting work, or it can be somebody else. So let's say in this situation it's somebody else that prepares the financials and the corporate does their own accounting records. So what happens is you're not busy with your financials, you've imported the TB that you've received from your client, and then while you're busy with the audit, you realize that they haven't accrued for the audit fee expense, right? So I'm going to process this. Let's pretend we are on the 2023 year. So in my year, it's a previous year, but we are busy with the 2023 audit. So what I need to do for the financials is I need to process that journal, right? To say my expenses was less. So I have to increase it with the 200,000, and my trade payable should become more because I'm owing this to the auditors. So straightforward journal that you need to process. Then if we look at the slides, let's talk through the different options. So what will happen then, as soon as I process that, let me just go to my financials. My profit would change, but my current year would also change. So because my retained income have changed, because my expense have changed, right? So the flow comes from the retained income. So let's say 2023 is now signed off, and then I've imported my 2024 TB, and this is the result that I get. And now I'm like, what journal do I need to process? Why is my retained income not working? It agrees to the TB, all of our discussion. So if I then, oh, sorry, just jump back into here. Let's talk through it. So this is a journal that I've processed. So I've got my expenses, which was my audit fees. My balance was the 125. I've processed a journal of 200. So it increased my expenses to 325. And the same with the trade payables. So that was my journal that I processed in my apps for the audit fees. So now different things can happen. In the first instance, let's say you process this in your 2023 accounting system. So the accounting system that your client use is still open, they can process it. So after you were done with your 2023 financials, they process this journal in 2023 and it's great. Then you won't have a difference because it's accounted for in your TB and in your accounting system. What can also happen is the client actually never give you this journal. They process it on your accounting system while you're busy with 2023, and they give you a revised TB with this journal included. So whichever scenario plays out, you will not have to do anything because it will be already included in your 2024 opening balances. The next option is 2023 was already closed. They couldn't process any journals in there. So now they're processing it in the 2024 accounting system. And there you have to ensure that they've processed this against retained income. So if you look at the journal, you can't increase your 2024 expense with the 200,000 because you've already expensed it. It's already part of your retained income that accumulated over the years. So you can't expense it twice because then you're going to double up. So you have to process that journal against retained income. But then your other side is still trade payables. Why? Because it's not in your opening balances for trade payables. So if this happens, you have to process that against retained income. So this can be processed either on your financial statement level or on your accounting system. Ideally, you want your journals always to be processed in your accounting system because you don't want to carry over these journals indefinitely. It becomes quite mundane, it becomes very hard to have the history, and it really causes a lot of issues if you go forward. So ideally, you want it to be processed in the accounting system, if not in the current year, at least in the next year, that they can be in the figures already, especially also if your clients have management accounts or they report on the TB throughout the period. They don't want to report on something different than what they report on their financials. So it really is important to process these journals actually on the accounting system. There are exceptions of journals that only gets processed for financial statement purposes. If it's perhaps a reclassification or something like that, then you will always just have them for AFS purposes. But ideally, like I said, these should be processed in your accounting system. Then the third scenario that we have is your 2023 system, accounting system, was already closed. So again, the same scenario as scenario 2, you process it in the 2024 accounting system, but you process it as a normal invoice. So if you think about it, how it works is your audit fee invoice come out, auditors ABC, the client gets it, and what do? They go and process it in the accounting system, and they would go expenses and they would go trade and other payables, which is not wrong because this is their normal course of business, how they would process invoices. But now what happens is you see you already accounted for that expenses in 2023, which was right. So for AFS purposes, you'll have to reverse that 200,000 out. Sorry, I've got it here to trade payables, but you reverse it out because it's already been accounted for and you don't want to double count for it. So the client is right for it to go through their accounting system in their normal course of business. But you have to then reverse it out that you don't double count for us purposes. So if we go back to Caseware, before we jump, I give back to Angela. So what does it mean in Caseware? So if you are in option 2 or option 3, where you have this difference here, it means that your retained income needs a journal. Again, your retained income will probably not be affected because you have that figure that you've typed in. But this is telling you there's a difference between your TB and what is in your statement of equity. So very simply, and sorry, just to jump back here and interrupt myself, you'll see here that it's got the 2 now there. And why that is remember when you chose this cell as your plug-in cell, you chose that only 2 Rand gets rounded. So if we go back there again, if you maybe missed it. So this is 2. So because this is now obviously much more than 2, it won't round anymore. So as soon as this increases more to what the limit is here, what you've put here, it won't round it anymore. So you can see it could go up to 15, but if it's more than that, it won't round. So how do I process this journal? Like I say, very simple in this case, retained income, trade payables. I've already accounted for this audit fees in 2023. The client haven't processed, I forgot to give them the journals. So I can just process them that way. And then you'll see my 200 will be correct. My retained income is balancing. And because my rounding is now again just a 2, it will balance automatically back to this figure. Okay. So that's it for me on rounding and retained income. As you can hear, I'm quite passionate about it because it's something that comes up a lot. It's very, and if you just stick to the basic principles, it can be easily solved. It does become more complicated if there's a lot of journals and you have to figure out what the clients have processed and whatnot. But that would be my first step, is to see what was the journals in the previous year, what have they processed, what have they not processed, and what was the intention of it. Okay, I'm just going to quickly double check if there's any questions before I hand back to Angela. So I've got a question here. Is it possible to export Caseware mapping number listing in Excel prior to importing the TB? I would like to export a blank TB template, update it on Excel, and import to Caseware a TB that is already mapped. So the easiest way sorry, that you can export this is if you go to your trial balance here, then you have your mapping numbers here, and you can have to think Control A, and then it's like Excel, and you can right click and copy this and you can put it in Excel, and then you can import it with your mapping numbers. Okay, I don't see any other questions. I'm going to give it a second while I'm handing back over to Angela. Thank you very much, everybody.
Perfect. Thank you very much, Ninka. I need to now just try and realign my mind back to other comprehensive income after that very interesting session with you. All right, so I'm going to be looking at other comprehensive income, but my focus is on the way that other comprehensive income works in the Caseware templates. So what happens is that other comprehensive income is very specific items. If you look in your IFRS standards and IFRS for SME standards, there are very specific items which are listed as components of other comprehensive income. So you can't just decide for yourself what you want to use. It is specifically listed. There is not necessarily an understanding process there. The answer is simply because they say so. Those are the items that are OCI. It's generally gains and losses which are not recognized in net profit, and they will accumulate to your reserves. So it's your other gains and losses outside of profit or loss. An example, and the one that I will look at, is revaluation of property, plant and equipment. Now, just on that, we get in the IFRS and the SME, the different types of other comprehensive income items are specified as either those which will reclassify to profit or loss. Sometimes they refer to it as recycle to profit or loss, and you will have those that will not reclassify to profit or loss. And the two have to be presented separately. So what I have in front showing you here on my screen, I'm just going to use the SME template as an example. The mechanism works the same for IFRS, but you will recall that the components are going to be different in IFRS as compared to SME. But if you look at the statement of comprehensive income, you will see under other comprehensive income that there is a section for items that will not be reclassified to profit or loss, and another section for items that may be reclassified to profit or loss. And then those various items are listed. Okay, and again, they will be different. It will be a different list for IFRS as compared to SME, but the mechanism works the same. So when you're dealing with other comprehensive income, like for example, a revaluation of property, plant and equipment, for presentation purposes, it's necessary to identify the components. So this would be, for example, the gross transaction amount, the tax effect, and if there were any equity accounted investments, right, your associates or joint ventures, if they had an OCI item, then that share that belongs to our entity should also be identified as a movement or as a type of other comprehensive income. At this point in time, I'm ignoring non-controlling interest because we haven't dealt with consolidations as yet, but non-controlling interest would also be accounted or taken into consideration at a later point. So what you would do, so your gross transaction amount would be the actual amount of the transaction. So for example, if you're revaluing property, plant and equipment, that would be the amount of the revaluation. The tax effect would be, well, what was the deferred tax component of this? And then the share of OCI of equity accounted investment would be, well, did an associate revalue property, plant and equipment? What was our share? Let's say it was 20%. Then we would take that in as part of our other comprehensive income. So you would identify the various components. Now, if you take all the components together and you net it out, that amount impacts the reserve in the statement of changes in equity. In this case, the revaluation surplus reserve. But the components have to be reflected on the statement of comprehensive income. So these items should show separately on the statement of comprehensive income. So again, I go back to my screenshot of the statement of comprehensive income. And if we look to our components, the gross amount is split out by nature of transaction. You can see exchange gains on translating foreign operations, cash flow hedge, actuarial gains on defined benefit plans, revaluation of PPE, cash flow hedge, right? So the gross amounts showing these lines. Our tax component will then show as a single line item per nature of items which will be reclassified to profit or loss or not. Or just look at the line item income tax relating to items that will not reclassify to profit or loss. This is the tax effect of all of these individually split out items. Likewise, for the items which may be reclassified to profit or loss, it's the income tax relating to all of these items, which for SME is just the one, the cash flow hedge. For IFRS, there will be a few more. The other two line items that are shown in the green block, these are separate, but I've highlighted them because they're also taxed. The income tax effect of tax rate changes and prior period over or under provision of deferred tax. This will only happen on the odd occasion should it be that you've raised deferred tax through OCI sometime in the past. So let's say we had a revaluation reserve or a revaluation done a few years ago, and deferred tax was raised at that point in time. If there was a rate change adjustment, then, and there wasn't another revaluation, the deferred tax on that item will change because now the tax rate has changed from 28 to 27%. So that change would come through on this line, and you would map it to this line. So that's just, and then similarly, if you had over or under provided for that deferred tax, you would just bring it to this line. These are not really expected to be used commonly. So our focus is on the income tax relating to the items above. The next component is if you had a share of OCI for your equity accounted investments. Remember I said, let's say you had a revaluation done in an associate, then your share of that OCI will come through in this line. So that's what I mean when I say the different components are split out in the statement of comprehensive income. But in the statement of changes in equity, there is one line item for other comprehensive income, and the full amount of that, the net amount of all those components will land up in the revaluation reserve column. If it was foreign exchange, it would have landed up in your foreign currency translation reserve. But so the full amount per type of reserve lands up in its individual reserve column. Okay, so that's the first step in where do the items come in. Okay, and I've said that it was a single amount. What is Caseware's mechanism? So how does Caseware get these various amounts to their various locations? So we have created a note called the Other Comprehensive Income Note. This note is almost like a work paper, which takes every type of OCI transaction and breaks it down into its component parts as gross, tax, a share of equity accounted investment, and so on. So you need this note to be completed and to be switched on in order to complete your OCI, your statement of comprehensive income and your statement of changes in equity. And this note also impacts your cash flow worksheet, because you'll remember your cash flow worksheet takes all non-cash movements against every balance sheet item to determine what is left as a cash flow movement. So if you have a revaluation reserve, that means, and you did a revaluation in the current year, that means there was a non-cash movement to your revaluation surplus, and your cash flow worksheet will get that number from the Other Comprehensive Income Note. So that note is important. However, the note is not a requirement of the IFRS or IFRS for SME accounting standards. So you might say to yourself, no, but the standard doesn't say I must have this, I don't want it. Please don't don't remove the note from your file. You need to open it, populate it, and if you don't want it as part of your financial statements, you can just close the note so that it doesn't print, but the background will still work so that it still populates your statement of comprehensive income and your statement of changes in equity. Okay, so let me show you the note. We are going to go into the note in the software in a moment. I just want to show you an extract of it again. So I'm in now my note, Other Comprehensive Income. It's towards the back of my financial statements. There I have, it says components of Other Comprehensive Income. My current year is 2023. There will be another section for the prior year. Then I will start off with items that will not be reclassified to profit or loss. So it's set up like the face of the statement of comprehensive income. Then I have gains on revaluation of property, plant and equipment. I have just extracted the portions that I'm using. You will notice that there is then, for revaluation of property, plant and equipment, I have a whole table at my disposal. And in here, it's a type of movement. So for example, gains on revaluations during the year or losses, adjustments to decommissioning provisions if there should have been, if there was a tax rate change, and any other movements which are very, very unlikely to occur. You are probably, like 99% of the time, going to be in this line. And possibly if you had a decommissioning provision on a revalued asset, then you could also be in this line. But these amounts are then broken into the gross movement. So the note says, so you can nicely see from this note, oh, there was a revaluation of 440,000. The tax effect was 115,000. There was no OCI from equity accounted investments. Taking this into account, we'd get our net movement, which would be the full equity. If we were dealing with consolidations and there was a non-controlling interest, we would take that off, which means that our final column would be, if you think about it, the amount in which is attributable to the parent. So in other words, after non-controlling interest, which is the amount that goes into the various columns in the statement of changes in equity. Because each column in the statement of changes in equity, like your share capital, your revaluation surplus, your foreign currency translation reserve, that is the reserve to the extent of the owners of the parent. But I don't want to elaborate on that too much. I just want to show you this is our net movement for revaluation. Do you see where this table ends, the small table? It's totaled here. Each type of OCI item has its own table that follows after this revaluation. So your foreign currency translation reserves, your cash flow hedges, and so forth. So all of those OCI items, they will then total to total items that will not be reclassified to profit or loss, and it will add up all the tables. In this case, I only had the one, which is why my total here is the same as my revaluation. The next section will then be the items that will reclassify to profit or loss. Each of those items will have its own table. It will also have a subtotal of all of those items that will reclassify to profit or loss. And then there's an overall total of all your other comprehensive income. Now this note pulls through to the statement of comprehensive income and the statement of changes in equity very specifically, and I will show you how each one pulls through. So we're first going to look at the gross movement for every type of other comprehensive income. So this extract, I've just made it a bit smaller. It's the same one. I'm looking at gross movement. What happens is that per type of other comprehensive income, let me just pull everything up. So for each type of other comprehensive income, the gross movement must show on the statement of comprehensive income. So our table for gains on revaluation of PPE, we want the gross movement of that individual table to move to the line item. So on the right is my statement of comprehensive income, the line item gains on revaluation of property, plant and equipment. So this 440,000, look nicely where it comes from. It comes from the total of the individual PPE revaluation table in the OCI note. The next table, if there was a cash flow hedge, it would then take this gross amount for the cash flow hedge table and it would put it in there. Okay, so you understand, so it's per type of OCI item. The next one is then our tax column. How does the tax work? Well, so I've just broken that extract a little bit smaller to make space. I'm looking at the tax line. Now what happens, if I bring everything onto screen, is that the IFRS and the IFRS for SME has allowed options of presentation. For example, one of the options is you were allowed to show each type of OCI item with its tax under it. So you would have had exchange gains, its tax, cash flow hedge, its tax, gains on revaluation, its tax, and so forth. Or as another option, they said you can just take the tax consequences of all of those transactions and group them together, but separately for the ones that will not reclassify to profit or loss and separately for the ones that will. So Caseware chose that option. That was just the decision that was decided is the most simplified way of presenting. So it's not, if you have a look at my extract, I'm not taking the 115,000 from the revaluation individual table. I'm taking it from the total items that will not be reclassified to profit or loss. And it's the same because I only had one item. So that tax amount lands up then in the income tax relating to items that will not be reclassified to profit or loss. If I had items which may be reclassified to profit and loss, then I would take the comparative amount, the total items that will be reclassified to profit and loss as it's presented in my note. That tax block will then land up here. Okay, the next one is our share of comprehensive income of equity accounted investments. In my case, it's 0, but I want to just show you where it comes from. It's the same concept as the tax. It's also in totality for items that will reclassify and those that won't. So it would look to this number, the total for that category, but not per type of OCI, and it would put it into share of comprehensive income of equity accounted investments. Okay, then I haven't demonstrated non-controlling interest. The non-controlling interest does not split out on the face. You can see there's no non-controlling interest shown here. This is because in our statement of comprehensive income, we show the full amount. At the bottom of the table, and it's again for a later session, your non-controlling interest and your parent portion splits out. But just sticking then with this demonstration, we then look at, so we've looked at how the note pulls through to the statement of comprehensive income, but how does it pull through to the statement of changes in equity? So what happens is now the net amount. So if you look, here is my note, other comprehensive income. In the statement of changes in equity, we only want the net movement after everything and even after non-controlling interest, if there was, to land up in the reserve, because we only want to know how much of the reserve belongs to the parent. So in the absence of non-controlling interest, it's the full amount. So we look to the last column, and it's not necessarily just per reserve, although it could land up kind of being that. What happens is that for every type of OCI that belongs to the revaluation reserve, the table will take the total, the software will take the net total for every type of OCI that relates to revaluation reserve. So for revaluations, it's only this revaluation of PPE table. So it takes the total here and it puts it in the other comprehensive income line in revaluation reserve. If it was our cash flow hedging reserve, there are 3 or 4 in the IFRS OCI items which relate to hedging. If you go and you look in the IFRS, you'll see there's quite a few. It would take all of this amount in the individual cash flow hedging reserve tables, take this amount, add them all together, all of these amounts together, and put it into the cash flow hedging reserve. I forget what the exact reserve is called, but into the related reserve in equity for that. Okay, so that is where the statement of changes in equity gets the number from. So now that's all fair and well. I've said to you how the items split out in the statement of changes in equity and in the statement of comprehensive income. And I've told you that it comes from the other comprehensive income note. Now we have to say, well, how do you actually populate the note? So there's 2 ways. If you were to map the components, this is, in my opinion, the best approach. If you map the components, being your gross, your tax, and so on, to the specific components in equity, then everything happens by itself. But if you map sometimes just to the opening balance of the reserve, then you have to do the table yourself. So what am I talking about? I will show you in an example. So my scenario, before I look at the software, is that we've bought buildings and revaluated them some time ago. So there was, we previously revalued by 590,000 before tax. So the net amount and what still remains in our opening revaluation reserve is 420,000. In the current year, we will put through a revaluation of 440,000, and the deferred tax on that is 115,000. So let's go and see what we would do in the software. So if you think to yourself, oh, it was a revaluation, what you would do, don't look at my journal exactly right now, but if you were just jotting down the journals on paper, you would say to yourself, oh, debit buildings with the amount of the revaluation, and then you would say credit revaluation reserve with the amount of the revaluation. Are you all still with me? Then you would do another journal if you're like me. I like to do all the steps. Some people like to just do one step. Then I would say the deferred tax effect, let's say it's 115,000. You would say, well, credit deferred tax in the balance sheet and debit the revaluation reserve with the same amount. Do you agree? So in effect, you would have, I think it was 325,000. We would have credited the revaluation reserve with the net amount after 440 and a debit of 115,000. So these two lines here, in my journal, this 5,006 and the 5,004, do you agree that is in fact the adjustment to the revaluation reserve? Correct. But I'm saying to you, because it is OCI, journal it or split it out to the component parts. Now, your client might not do that, so it would then be a separate journal for you to put through, or otherwise you might decide not to do it at all. But let's say you've decided to take it to its component parts. So let me show you the mapping. So you go account, assign mappings. Sorry, before I continue, I just see that there is a comment about no sound. Ninka, can you just interrupt me? Is the sound sorted out?
Yes, thanks, Ange. I believe there is sound.
Okay. Sorry, I hope that wasn't, it looks like a long time ago anyway. I hope that everyone has been able to follow. Okay, so on the balance sheet, we're going to go to equity and liabilities. Equity, and it was a revaluation reserve. So we look at our reserves and we go and we look for the reserve we're dealing with is the revaluation surplus. So as you understand mapping by now, everything within this collapse that you map lower than this line goes to the revaluation surplus. So in other words, if my journal entry goes to opening balance or to any of these components, I am actually taking it to the revaluation surplus. I hope you agree. It's just where you map it to is going to throw it into different places in the financials. So in my case, I have said, if all of these reserves, you will actually see the OCI portion split out as gross, tax, non-controlling interest, and share of comprehensive income of equity accounted investments. So for example, I will just open another one, foreign currency translation reserve. There is where you would split out your transactions if you're going to go that way. So just follow me on the revaluation surplus. So I have said for my credit to revaluation surplus, I created account 5006 called revaluation gross. That was the gross amount, credit revaluation surplus, debit, property, plant and equipment. I then also created a journal to an account 5004 called deferred tax OCI. This account was debit revaluation surplus, but my account is deferred tax OCI, but it's mapped to revaluation surplus, 115,000 credit deferred tax. So let's go and see what happens. If I then look in my financial statements, and I'm now in my statement of comprehensive income, and you scroll down to my other comprehensive income section, you will see gains on revaluation of PPE. There's the 440,000, and there's the tax effect. If I jump to my note, here's the other comprehensive income note. Here's all the component tables. Remember, I said each table. I just want to show you the headings: gross, tax, equity accounted investment, net movement, NCI, and the overall total. Let's scroll down to our revaluation. automatically the table's been filled in because I mapped it as such. And you can see 440 into gross, 115 into tax, and the 325 is the net amount. If I go and I look at my equity statement and I go to my current year movement, I see other comprehensive income, the net amount in the revaluation reserve. But now what if you've said, no, we don't want to create journal entries to the specific components. We just want to be able to take it straight to the revaluation surplus. So let me turn off my journal and go and switch on your journal. So there's your journal. Whoever wanted to do it the other way, you are your. Debit buildings 440,000. Credit my deferred tax on the balance sheet with 115, and my net effect is all to revaluation reserve. And I've actually, let me turn this on because I always forget. I've turned on the journal. Let's go see how this is mapped. So again, it's all mapped to retained to my revaluation surplus. It's just where in that surplus. So now I go to my equity, to my reserves, to my revaluation surplus. Do you see the amount is still the same? But now I've mapped it all to the revaluation reserve, which is assigned to my opening balance. Okay, although it's not the opening balance, Caseware would always take the previous year's closing balance as the opening balance. So you have not need to panic about that. If I go to my financial statements, you will see that the OCI still correctly identifies the 325,000 in revaluation surplus. But if I go to my statement of comprehensive income, remember we've not split out the movement, we've put it all to opening balance. Now you see there's nothing here in OCI. So let's go to the note. So if you go and you look in the other comprehensive income note, you will see that there's nothing in it, but there is an undefined difference which you need to clear. So the software works like this. It works out that there must have been a movement of 325,000 because it took the opening balance and the closing balance into account. And then it's telling you, please go and show the impact of that movement so that the OCI will be right. So now you actually have to go and put that in manually. Hopefully I can remember the amounts. And remember, you're going to see the red dot, not because it's wrong, but because it's a calculated cell. As soon as you type into a calculated cell, it gives you a red dot to just say you've overridden something. And you can always reverse it by right-click and selecting override, and it'll go back to the calculated amount. But in this case, we are happy that we want to override it because we didn't map the components. So now I'm going to type in the tax effect to get rid of that undefined difference. Then when I go back to my other comprehensive income in my statement of comprehensive income, now it's pulling the amounts through correctly. Okay, and I think that is all that I needed to go through with you. Ninka is just going to talk a little bit about what's next and check about further questions. So Ninka, over to you.
Thanks, Angela, and thank you everybody for joining us today. I have in the chats added the feedback form. It really helps us a lot. If you can please complete it, it shouldn't take more than a minute. Just to give us feedback on the session, on the topics, do you find it useful, and any other feedback that you have. I'm going to double check. There's no other questions at this point, but we are going to leave it open. Just to see if there's anything else that comes in. Then what is next? You would have been registered for the financial statement streams as you go along. So the next topic that we have on the 6th of June is cash flow and XBRL. So Angela has covered the cash flow very briefly in one of our previous sessions, but we definitely want to cover that in a bit more detail, and that will be during that session. And we will also cover XBRL, what it is, who needs to do it, and how does it work. And then we have another session on the 20th of June, which will be our last session, accounting policies and the roll forward and update of the file. So like I say, you would have been registered for all of these sessions. If you do have not been registered, I'm sure you've got Malaga's email address. It's on all the reminder emails. You can just reach out to us for that. Then I also would like to remind you that we are doing a template release end of July. You would have received emails already on it, on our roadmap. There will also be an email going out tomorrow about our beta sessions. So please keep a lookout on those, see where it affects you. For the financial statements, it's not a huge compliance heavy release, but if you do want to stay up to date, it will be good to be part of those sessions. Then, as always, join us on LinkedIn for the company, our Get Ahead Audit Intake series. And with that, and then also thanks, Ange, our YouTube channel. I've also put the link in the questions for somebody that asked for it. The recording will be sent to you and will be put on the YouTube channel and Facebook and Twitter. I hope you all have a lovely day. Thank you for joining it and keep well.
Thank you, everybody. Bye.